We're going to talk now with Simone Devenny, and she's doing a webinar with us on high net worth wealth strategies for 2025 and beyond. And so glad to have you spend a few minutes here. But first of all, give us a little bit about your background.
Sure. Thanks so much for having me. So I've spent about the last 25 years working with clients around all things related to estate planning. Started off as a tax and estate attorney, and then also on investments. So really looking at holistic financial planning and wealth management from the estate planning perspective, the tax planning perspective, and everything else that would be important to our clients.
And so what are some of the things that like high income, high net worth investors should be considering next year? What's actually different? I mean, I know one thing with the Trump tax laws were set to expire. There's a chance they won't expire, but that's still
there's a
up
chance
in the air. Chance they will.
Yeah, highly unlikely though.
But yeah, I think, whenever we think about planning, we can't predict the future, although we wish we had a crystal ball. But what we can do is work with the current laws that we have and think about the best ways to take advantage of opportunities that exist right now. So whether they're going to change again in the future or not, we don't know for certain. But what we do know is there are plenty of things that investors can be thinking about in terms of how to take advantage of the moment that we're in, whether that means, tax optimization of portfolios, things like Roth conversions, how to incorporate their charitable giving to enhance their after-tax, performance, things like that. And this is really what we help clients sort of navigate, even with the uncertainty of what's going to happen.
So you started out as a tax attorney, right?
Correct.
In your early, and I see you went to Boston College, which is where my son went. So good for you.
Nice.
That's the only reason why I like you, Simone, and the only reason we're doing stuff here at Allworth.
Go Eagles.
So, and how do you think about? Because one of the things that, as financial advisors, we always talk with clients, like you've got one big partner, the tax man, and
that's right.
We know what the tax laws are today, and we try to put some probability of what taxes could be in the future, because how else do you got to do some sort of planning, right? And then with planning, you've got some assumptions and some probability. So how, within your career with as a tax attorney, how do you think about that?
Well, again, I think what we really want to do is think about, okay, there's always a possibility that things are going to change. We take into account sort of the unlikelihood of clawbacks or the opportunities for grandfathering, things like that. And so we really plan using the current environment that we have. Right now, we happen to have a very favorable environment, certainly from an estate planning perspective around taxes. And so what we're doing now is encouraging clients to really think about using this very favorable, the favorable winds, I would say, to make sure that they're getting things in place that are going to be effective irrespective of how those laws might change. So again, great time to be thinking about planning with what we know now and planning for the eventual possibility of change, but getting things in place now that may not be impacted by that change. And that's what we really try to navigate.
So Simone, will you kind of give our listeners a little history when you mentioned the estate tax? I assume you happen to talk about the unified credit or the exemption amount. Okay, just because I
was explaining this to my 28-year-old daughter just over Thanksgiving. She's like, "What? You mean to tell me they tax you when you die?" She was like blown away. She's like, "Why?"
Can't get away from it.
But so I've been doing this a little bit longer than you. But when I first started, right, the number was much
$600,000.
Yeah. So give us a thumbnail for the rest of the listeners, and why when you said this is a favorable time historically, well, probably till the great robber barons was a better time, but give us a kind of the history of that.
If you were a robber baron, if you were 99.99% of the rest of the population, maybe not so good.
Of course I would have been a robber baron. Come on.
Well, you have been doing this a little bit longer than me, but I've also been doing this quite a long time. I am not as young as your 28-year-old daughter, sadly. And I can tell you back when I was at Boston College in the late 90s in law school, the exemption was about $675,000. And by exemption, we talk about what you can give away as a gift or when you die or some combination, right? So $675,000, and then anything over that would be taxed at a very high rate. Right now, we're looking at a 40% tax rate. But That $675,000 is the number that keeps moving, and it's what keeps estate planning attorneys in business, okay? Because essentially what's happened since the late 90s is it has moved all over the place, always moving up, except for in 2010 when it went to
Zero.
unlimited, right?
Yeah.
Zero. But then in
Zero
that year, of
tax,
course,
yeah.
we lost the step up in basis, which is a whole separate conversation we could have. But I think that, so, when I was practicing law earlier in my career, it was in the $1 million, $5 million, all over the place. But ultimately today, and this is where the opportunity is, today it's at $13.61 million per person. That means a couple's got, double that. Now, why do we have 0.61? The reason for that is because this was originally a $10 million number that was indexed for inflation. So it's just sort of moving along and growing at the rate of inflation. So next year, we still expect that is going to rise. However, this very high exemption, and this is one of the things we talk about, is set to sunset or, go back down to roughly, $7 million per person in January 1st of 2026. So this really summarizes sort of where the great planning opportunity exists right now for high net worth investors and high net worth clients to start doing some planning, knowing what we know now, utilizing that very high current exemption.
And with the exemption, what it means for the listeners is you can use any or all of it while you're living and move it to the next generation rather than wait until you die. And it's a great planning technique. One of the downsides to it is that in doing that,
no longer your asset.
It's no longer your asset, and you'll lose a step up in basis at that growth after the gift.
Because it's not your
That's
asset.
right,
Because
and
it's
I
not
think
your
that's
asset.
a great point. That's a great point. However, and this is where the fun comes in, there are a lot of really neat techniques that exist in sort of modern trust planning, where you can actually use things like substitution or swap powers. So working with your advisor, you can really look at optimizing the assets that you are transferring. So for example, if you gave away, let's call it a low basis asset to one of these trusts, you could eventually swap that out for cash or for a high basis asset, taking it back and getting that step up. And I know this may sound a little complicated, but we can certainly simplify it when we have more time. But really excellent planning opportunities around that as well.
Yes, you'll be covering some of these issues in the webinar. I know because you'll be with Victoria Bogner as well. And you're going to be talking about some interest rates and what kind of outlook. What are you guys going to be delving into there?
Yeah, so Victoria is fantastic, and she gives a really great overview of the yield curve. We hear a lot about what is this inverted yield curve and what does it mean and what does it mean for the economy? What does it mean for bonds? How should we understand the portfolio as it relates to the current state of the yield curve? So that is something really interesting that she goes into great detail on.
Okay. And before we go, and we'll give the dates here in a second, can you explain to me why we have a step up in basis? It never made any sense to me. What's the history behind a step up in basis?
Well, that's fantastic. So the step up in basis, actually, it's funny. So what is a step up in basis? Step up in basis means if I buy a share of stock for $1 or a house for $1, okay, and I hold it until I die, and when I die, it's worth $100, my heirs will inherit that. And their new cost basis is not the $1, it's $100. So if they sell it the day I die, they won't pay any capital gains tax, right?
Yep.
Now, the origins of the step up in basis actually have more to do with sort of operational challenges, meaning that it was so challenging for people to go back and try to figure out cost basis over a lifetime that eventually they just made it so, you know what, we're going to step it up and just let it go to the heirs with what's called a date of death basis.
Oh,
right.
Thank you so much. I've always wondered that.
It's a silly thing, isn't it?
Yeah, and by the way, if you were in charge of the world and you wanted to create liquidity where capital would move to the most efficient places, if you believed in a economic environment that allowed for that, you would get rid of the step up in basis.
They've threatened it many times. In fact, very recently, there were some rulings that came out that have threatened and, in fact, probably done away with that step up in basis with some irrevocable trust. So it used to be that we thought we could plan around that, but that has changed. So yes, it is sort of the proverbial low-hanging fruit, if you will. So we should certainly be taking advantage of this step up for as long as we have it.
Well, Simone, thanks for taking a little time out of your busy day to talk with us.